Okay, this is gonna be a very short session. Um, it's by that I mean it might not be as long as I anticipate. But however, we were discussing something yesterday, so I intend on rounding it up, right? Before we of course end the week. Okay. So this will be a continuation of yesterday's um Confluence trading with the Fibonacci retracement and the extension and fair value gaps, right? And fair value gaps. Okay, this is for scam and fair value gaps. Okay, so there's a thing I noticed yesterday. I told us, right? I told us that our daily bias yesterday was a bullish daily bias, right? So I was looking at this high. I can remember saying that I expect this high to be broken and all that. But if you look at this, if it's in terms of a fair value gap, right? This area has been respected already. You check the point between this and this candle, it has been respected already, right? Then also, as of yesterday, the market started around here, right? So if you remember the power of three, I told us, right? Power of three is first off manipulation, then accumulation, manipulation, then distribution, right? So what you actually saw yesterday was the first manipulation, tricking even me, right? Just like every other trader, thinking that okay, this is a bullish day. But if I've put that into consideration that yesterday, I would have been able to know that this market is actually going to sell really hard for that particular day, right? It's going to sell really hard. Okay. Um, why? Now, another reason why I said I'm expecting a bullish momentum on that particular trade is because of, I see a high, I see a lower low, and of course a trend. Though this can also be called a high, right? The market's created a lower. If you look at it now, this is a lower high though, but this is a lower low instead. So perhaps I thought, okay, my expect the market to even break these highs as of yesterday and keep up trading towards this area. But what did he do? It went down instead. Now, this move here would make sense, right, on the 4 hour time frame. Because from the 4 hour time frame, I was seeing a bearish market anyway. On the 4 hour time frame, I was seeing a bearish market. So we can say that on a long-term move, right, there's a bullish market. On a long-term move, USD, um, um, the Australian dollar is expected to gain against the USD. Now, let's take a look at the dollar index. Now, I did this analysis on the dollar index yesterday, right? I anticipated this break. In fact, I saw this. Remember when I tell you, when you have an area of equal highs, I expect the market to break it, right? So when looking at this, I assumed, right, that would be a continuous, that this trend, this zone here will still be respected. And if it's respected, that means all the pairs attached to USD would gain, right? While USD falls. But what we are seeing here is that the dollar broke a range that's been holding it for like since 21st August. It hasn't broken above this zone. And for yesterday, okay, but yeah, yes, even as of Wednesday, it couldn't break it. So yesterday, that's when it broke that particular zone. You can see, so this is a clear break. So with this move here, perhaps we're expecting dollar to keep gaining. And for dollar to keep gaining, other counter pairs would continue dropping. All right? They continue dropping. So this move here, I literally don't know what next. But for today, right, I expect the dollar index to get to this point. Just the high of yesterday, that's all. So sorry, the high of Wednesday. I expect it to touch the high of Wednesday. Anything it wants to do, I'm looking at it to touch the high of Wednesday. That's all. That's what I'm looking at for the dollar index. So if I'm expecting a bearish momentum, a short-term bearish momentum on the dollar index, that means, right, I should be looking out for bullish momentum on other pairs I have. So let's go back to AUD USD. Right. So that being the case, we'll be expecting a little push above, right? To use our rule of three, right? The market has done its first manipulation, right? And it's moving upwards, right? In this particular point, this will be my target area for today. The high of Tuesday, right? The high of Tuesday, or I'll say the open of Wednesday, however the case is. But I'm looking at my area of interest is this point over here. That's my area of interest from the daily time frame, right? So we have this. This is us analyzing the market together, right? We sit and chill, observe, as always, and see how the trade plays out, right? So we're expecting a bullish momentum for today, hitting the low of Tuesday, perhaps the open of Wednesday. Okay. Okay. All right. So let's let's now do our analysis, basically. Or let's go over what happened yesterday. Okay. Let's go over what happened yesterday. So remember, we were able to get this point. We were able to get this point. We were able to get this from the 15 minutes time frame. If you can remember, this fair value gap from yesterday. I told you when you have series of fair value gaps, if it's like 3, choose the one at the middle. If it's 5, look for the one at the middle and select. So we had this fair value gap, right? And what did the market do? Came back and respected it. Now, we didn't just choose a point for the market to react from. Remember, we went down to 5 minutes time frame to confirm that this trend, right, is ready to start selling. Okay, we have a high, have a low, have a high. We had a new low. This was the point I actually said, okay, yeah, we now know for a fact that this guy is ready to sell because it has taken out, this is a change of character, change of trend, whatever. It has taken out this old low, right? Market did this, so this is our valid opportunity to go in. But then there is how will you get your precise entry, right? Also remember that I went down, or we went down to the 1 minute time frame. Went down to the 1 minute time frame, right? We saw I don't know why it's also. What don't you understand about the candles? Okay, first thing I'll ask you, have you asked this question on the 9 p.m. session? Have you asked question about candles on the 9 p.m. session? That's number one question. If I get a response from that, we'll handle that. All right. So I've seen your response. I'm coming there right now. So now we spotted this fair value gap, right? On the 1 minute time frame. This is it. the low of this candle and the high of this particular candle here. I marked it out. In fact, this was when the session ended, right? We saw a sharp move into this zone and the market sold aggressively. So from this particular point, now imagine, one thing about, I said before that session ended, I made an emphasis. The reason why you break down your charts, right, to lower time frames is to reduce perhaps the amount of risk, your SL, right? So in this particular point, my SL would have been just above this point, or I can choose the candle that gave me, I can choose here, the candle that gave rise to the fair value gap. Just pick any point above it. Now I'm risking just 1.4 pips, if that's the case here. Risking 1.4 pips to target 12 points, right? Remember, my target is a fair value gap I saw on the 15 minutes time frame, which is down here. I'm coming to you, which is my target is a fair value gap I saw on the 15 minutes time frame, which is down here, right? I was like, this is where my target point is. I'm going to choose the tip of the fair value gap. I'm done, right? I am done. If you look at, I said combining, when you trade, combining, what's it called? Combining Fibonacci retracement and extension is fair value gap. Now you've gotten this. Let's just say you decided to combine. You decided to combine. This is a swing, right? You can call this a high, a low, as the case may be. Or let's just work with this entirely. This is a swing, right? And you decided to target the 50%. This is the 50%. Remember I told you that in most cases, the 50% always get hit. As a minus 50% always get hit. So imagine you decide to target the 50% and not just take 100%. Now, also notice that the 100% of this swing, right, is actually almost the starting point of this fair value gap, right? So we took the trade, targeted the 100%, or like let's say the 0% as the case may be. So you decided to extend it towards the 50%. It's like a whooping 19 hour for you, including the fact that you got your entry from the 1 minute time frame, right? So you're risking just a tiny bit to aim for this. Now, know something, the market isn't always this smooth and beautiful, right? You might decide to target minus 50% and you get taken out. You mustn't even target 100%. You can decide to target the 50% of the swing, half of the main trend, and take your profit and go your way, right? So you mustn't aim for everything. But this is a confluence trading, yeah, a confluence trading, adding two things together to get an idea, right? So that is it. I think I'm going to leave this back here and take this out, right? So this for yesterday, a very smooth sell. Now, the reason for this push, I can't really tell, but I know around 2:30, I think there was a high impact news yesterday, also resulted to this, right? Now, here's another thing. What did the market do? Market came here, took out, let's say you are still holding. If you are still holding on to this trade, the market would have taken you out when it came back here, right? And of course, there is always have this, just know this here. Just know this. This is always a signal. This is always a signal for a strong sell. The market always tends to take out the former high to now sweep the low. These all these SMC guys always have terminologies for this. But so far I've understood, I've seen things like this happen over and over and over again. Hope I'm loud. Hope I'm loud. I see things like this happen over and over and over again. A high swept, then the low taken out. Taken out. When I mean taken out aggressively. Observe every strong move that has happened in the market. It's always similar. Either the reverse when it comes to buy or this when it comes to sell. Look at this high here, right? This high was swept, taken out. Now, someone looking at this now, that is not someone that is looking at this might think, okay, the market is about to buy. But this is a fake out. It happens. This is just I don't know, this is just a liquidity sweep if I want to say that. Right? Let me see. Okay. Yeah, good morning. Which is red, which is green. Okay, okay. Great man. All right. See, sorry, right? Sorry, my chart has a different color. So sorry about that. Now, this is my green, right? This is my green. If you're still here, this is my green, and this is my red. I think I would, for the benefit of the newbies or however they care, I might need to change my chart. But just know that the buy candle, the bullish candle is green, right? The bearish candle is red. So in my own case, my red candles are white and my green candles are black, right? Or colorless, if I would say. They're not really black. They're just hollow candles. Okay. I hope you're still here. If you've left, then oh, I think he has left already. See now, he has run up. How then is he going to learn? But it's all good. So, but I hope you're getting the gist, right? That is what it is. That is what it is. Now, if it's a case of, in this case, all you need to do just, if you are to entertain this sell again, just have a healthy stop loss, right? So you don't get taken out here. These are cases where you take a sell still and you get taken out before the market goes your way, right? Before the market goes your way. So this is like a very good box wave even, right? I'm trying to use it. With some my short position thing. Yeah, starting at the tip. The market came, respected. Yeah, target is just this point. Stop loss should be, let's say, 5 pips, or let's say 3 pips. If it's 3 pips, the market will kiss your stop loss before disappearing. If it's 5 pips, you are safe, right? If it's 5 pips, you are safe. This is a healthy 1:4. And this same thing would have been applicable here. So you enter there using the same box rate, like so beautiful. Isn't that what positive is about? Right. So that's the thing, right? I just need to update you on this, right? So the market did the move. Now, let's say you are here at that particular point. How do you now know when to get your best entry? The market has hit your point or according to this area. How do I now get a good entry here? This is already an idea, right? So well, let's see if you can get a precise entry, right? Also looking for fair value gaps, and even on the 5 minutes, we have it. After this move, market came down, the imbalance, your entry, you're good. Let's just mark it out. Came back, you saw this, right? This the balance between this candle and this. Where the market came in here, you enter. Is you either choose the high of this candle, or if you want to play safe, pick the high of this. The high of this candle that gave rise to the fair value gap. Pick the high of it. All right. Or you can just, however it is, take your trade, right? boom, whatever you want to target, the market sold aggressively yesterday, right? Entry. Now, no, the market is not always this smooth, right? Market is not always smooth. Okay, do you mean how to place your stop loss? Is that what you're saying? How to place your stop loss? All right. Now, here's the thing. Yeah. In your personal analysis, your stop loss is what you are risking, right? Any amount of stop loss is what you are risking. In this particular case, let's zoom it out so that in this particular case, you can see the high and low of this. You said take the entry. Your point is once the market gets into this zone, and what's the price of this zone? 0.6337. I think we'll have to write some things out now. Zero point 0.66. What was that price again? 0.66037. So this is your entry, right? And you have you want to risk, let's say you want to risk just 5% of your account, right? And 5% of your account is $5. Let's say you just have this ADS. Let's say you just have what's it called? $100 account. And risking 5% is $5, right? And you enter the trade at this point, 0.37. Enter the trade at this point, having a stop loss of 3.3 pips. That is above this particular account. Let's say 3.5 pips. I see right here. 3.5 pips. Now, to risk 5% of your account, right? To risk 5% of your account on a 3.5 pips, right? All you need to do, just a little calculation, right? Because first of all, one lot is already, one lot is giving you like, if I'm right, plus or minus $30 already. If I'm right with what I'm saying, $30. So 0.1 will be giving you like 3.5, right? In fact, sometimes here, this is what you can do. MT5 made it easy, right? Now, you mustn't, once you have your entry points here, bring your, what's it called? Your, this thing I'm saying now, it varies with brokers. Your one lot difference might be the same as another broker's 0.1. So your 0.1 can be giving you, can be $1 per pip. You can be risking $1 per pip with 0.1 lot size. And in another broker, one lot size is the same $1 per pip, right? You are risking $1 per pip. So if you're risking $1 per pip on this particular trade, all you're risking is $3.5. So you're not even yet risking up to the $5 you want. So you're looking at that, you might want to extend your stop loss to like, let's say 5. Just keeping at 5 points, 5 pips rather. So with $1 per pip, you're risking $5 already, right? So you know anyhow it is, if the market hits your stop loss, you're only risking $5 on that trade. And that's what you can afford to lose on this particular trade, right? If you're entering with 0.01, what you're losing here is like 0.5, right? You're not even risking up to 0.5, right? 0.01. That means what I'm saying here is if your broker deals with, if your broker is what's it called? One lot, $1, right? What you're risking here, if you're using 0.01, you're using 10, you're using 1 cent. I'm to get it right. 1 cent per pip. So if the market hits your stop loss, what you're risking here is simply 0.05, not even up to 10 cents, right? If you're using 0.1 lot size, what you're risking here is just $0.5. That's like 50 cents. Okay. So this is how you know what you're actually risking. In fact, it's easier, like I said, on MT5, where you put your SL, you see the market showing you, this is the amount you're risking on this particular trade. This is the amount you intend to make on the trade. If you see it on the chart, it's on your chart, that's chart screen, right? So this is how getting your entries or stop losses, that's apart from you knowing exactly what you're risking. This area here. Now, in the case where you want to keep it just above this point, you can risk like $1.2 per pip. That's like 0.12 or 0.11, right? You know, if you do the calculation, okay, this is the 3.5 pips. Before it will get here, this is an average of 3.7 or 3.5 times 1.2 will be giving us roughly 4 point something or 5, if I'm not wrong. If I decide to do that calculation, right? So this is how to actually get the exact thing you're risking. Because the most important thing is not even about, it's not even about the pips. It's about what you are imputing. Because for someone else, this 3.7 can be $3,700 risk. For someone else, it can be, it can be $700. For someone else, it can be $370. For someone else, it can be any amount. So the pips is there, right? But your risk, your actual risk, is what determines everything. So a big account can seem like a small account. Imagine when you have um, a, a, a 10K account and you're risking 10%. That 10K account, what you're risking there is the same with someone that has a $10 account using $1 to trade. So your risk sometimes can make your large account very small, because the chunk you're taking out of the risk makes the account look like it's nothing, right? But when just the whole game is just to manage your risk. That's the whole thing. Just manage your risk, right? Sometimes you mustn't even risk up to, if you have a large account per se, or if you have a funded account, a proper account, you mustn't risk up to 1%. You can just risk like 0.25% or 0.5%. This gives you room. This makes you not to even overthink some trades. Just let them run, right? Is someone talking here? But do you get it now? You'll see. Is it clear now? Because the risk is the most important thing. Sometimes we chase reward, but the risk is first. If you look at it, they don't say reward to risk, is risk to reward. All right, man. All right. You can also, on your own, go back to it so you can get clear even more. Okay, so you can get clear even more. Is risk first? Is risk? It's in the top one here. Look at this. All right. Is reward first? Love it. Abby Elizabeth. Is reward first? All right. Is risk first? Because at the end of the day, it's what you're risking that matters. Okay, the reward can be there, but don't chase reward. Make sure the risk is in check before you start chasing the reward. All right. Sometimes, like I did this mistake. I'll set a trade. What I'm concerned about is my TP. I'll set TP, leave SL. That's crazy. I'll set TP, leave SL. Right. I'm more concerned about what I'm gaining than what I'm about to lose. Right. As we get better in this craft, we get to understand this. Right. I know that trading is as beautiful. See, Sometimes this can actually give you heartaches. But that's how you ride. Every day won't be as smooth as, but that's how you're gonna ride with this. It's gonna be, I don't know, this is like a marriage, right? When it comes to marriage, so marriage is not always that sweet, but you just have to ride with it. Yeah. There are days that are so beautiful, some days are not as beautiful as that, you know. But if you get to find how to navigate the sea, you just have to enjoy it regardless. And enjoy, not just enjoy regardless, you enjoy and you actually know you're enjoying the marriage. This is how marriage is treating because you can't just leave it. No matter how, you can't just leave. You can't just leave it. You might want to, but it will just haunt you. You know, don't have to express it, but I know what I'm talking about. So, family, that is it about it when it comes to getting your entries with the Confluence, combining Fibonacci retracement. And okay, let's before this call ends, let me also show you something. Right, this is swing high, right? Let's pick this point to this point. Let's pick this point, but let's say we have a. This one shows it, right? This is it. This is our swing high. So we decided to target just 50% still. Where's the 50%? This point. You want to add all those other extra percentages and all. Let's say the 100 minus 1, perhaps minus 1.5 and the likes. So this particular market hits all those marks, right? So this would have been a very good, I don't know, this would have been a mad, amazing trade. Like, would have been so dope, but it is what it is. So you can see, this is just to tell you that you can always, marry your strategy with a Fibonacci extension, right? And this 150 points is actually the low of this particular zone, right? I hope this makes sense. And I hope you get to practice it so everyone. Coupled with the loads of strategies, or coupled with the already existing strategy we have, right? Everything is for you to practice, get better. All of them is to make sure to reinforce what you already know and to solidify or to give room for what you're here to do. All right. Practice, practice, practice. The market isn't always this smooth. You see how smooth this ADS has been flown. Market is always this smooth. When you meet those pumpy, crazy markets, I pray you have the grace to navigate the market. One. Number two, know when to leave the market because for every distribution, right? For every accumulation, that's a distribution or a manipulation, right? When the market seems to not make sense. In fact, that's when we even make most of our money, right? When the market seems to not make sense, we break down to a very good time frame, mark out the price trap, take ourselves, right? But when the market seems not to make sense to you, you look at the chart, you're not seeing anything. Let it be, right? This is like a wave. If it's turbulent now, give it time, it's going to be a smooth sailing sea. Everything will just keep flowing. Like, wow, who did I bribe the gods? No, or is the market, am I just like the god of the sea? Are you the Poseidon of the markets now? No, just market aligning with what you already know. Market mustn't always go away. But if you know what you are doing, we'll be there to be able to make enough. We are like tiny grain in this market. We retail traders, we are like tiny grain in this market. There are whales here that move the market. But our goal is to ride with the whales and take these crumbs, the crumbs they are making. And that crumbs can make us good living, basically. All right. So, family, that's all for today. Um, I believe if you have questions, we have the 9 p.m. session there to handle all of them, right? So practice, practice, practice. It's going to be an amazing day. I'll check to see if you have any high impact moves today. Anticipate it's getting better and it can only get better. All right. Cheers.